Common ownership is a situation where the firms in an industry that usually would compete against each other are owned by the same set of owners. So usually when you and I have own a firm in an industry, you would probably own mostly firm A and I would mostly own firm B, and you'd be only interested in the profits of firm A, I'd be only interested in the profits of firm B. We wouldn't care so much about the profits earned by the other firm. However, when you have very diversified shareholdings, you suddenly not only care about the performance of one firm in the industry, but you care about the profits of other firms in the industry as well. So that has been shown to have negative effects on competition. So competition is no longer as intense. Okay? And we were interested in what that mechanism is that leads from this common ownership to a lessening or softening of competition. Okay? And the obvious candidate for this is top management incentives. Okay? So what we ask in this paper is now, what is the effect of common ownership on management incentives? And what we show is that it leads to primarily performance insensitive compensation. So what does performance insensitive compensation mean? It means that you are no longer getting as much rewarded for your own performance, and you're no longer getting punished as much for the performance of other firms in the industry. So in effect, you're no longer doing relative performance evaluation for your CEO or for your top management executives, but instead you seem to be just paying them kind of more fixed wages and not so much stuff that is based on their relative performance to other firms in the industry. What we show essentially in this paper is that when you have common ownership, the owners of those companies are no longer interested in using relative performance evaluation. They no longer want to punish you for good performance of the rivals, but instead they may even want to reward you for good performance of your rivals, so that you take actions that lead to a softening of competition. The main effect of common ownership tends to come from large asset management firms, such as BlackRock, Fidelity, Vanguard, and so on. These hardly ever show up among the top 10 shareholders in the 2,000 largest listed companies that we use in our data analysis. So in 1994, there's hardly any of them among the top 10 shareholders of firms in those 2,000, in this universe of 2,000 firms. However, if you go to 2013, suddenly in 70% of firms in our sample, they are among the top 10 shareholders. Okay? So why is it particularly these asset management firms that lead this? Well, it's coming from the fact that many retail investors have become diversified. So if I'm investing in the stock market, finance over many years has told me I shouldn't just put all my eggs in one basket, but instead I should be diversified. Okay? So I shouldn't just place a bet on one company. I should be nicely diversified, and that means also that I'm going to be invested now in several companies in the same industry. So if many retail investors are doing this, they're all holding relatively small percentages of the stock ownership of these companies. Okay? Their votes on management decisions or sort of shareholder decisions are going to be aggregated by the asset management companies that they use to invest in those industry companies. So that means now the asset management companies such as Fidelity, BlackRock, Vanguard are going to have a lot more say, or they now have a lot more say on boards or in shareholder meetings than they used to have 20 years ago. So we've seen this very strong rise. It mainly comes from a totally benevolent effect of just more shareholder diversification. Now all of these asset management companies have a stronger say on the boards and on the shareholder conventions of those companies. Okay? So that wouldn't be a problem if they were just invested in one company in each industry. Okay? We would still have strong competitive effects. We actually know that these asset management companies tend to have a positive effect. They tend to introduce good governance. Okay? The problem, however, is that they are now diversified, they invested in many of these companies in the same industry, and now they have an incentive to lessen the competition among those firms. Okay? How do they do this? Our paper says that they do it through changes in the executive compensation. We tend to think of these asset management companies as relatively passive investors. We don't tend to think of them as sort of bulldozing their way onto a company board and then saying we're going to radically change all these things. They tend to be relatively passive and sit back. Now, if they sit back and they're passive, how can they really change executive compensation? Well, the way that they change it is by actually not doing so much. Okay, so they're saying there are these proposals for executive compensation. Okay? Most of the time, managers, as we know from previous research, they enjoy the quiet life. They enjoy not having too strong incentives, sort of stuff that punishes them for bad performances or rewards them very much for good performance. They don't actually like that all that much. So what tends to happen is that the types of compensation that is being suggested or put forward to a vote, it tends to be relatively performance insensitive. Okay, sort of exactly what you would want if you have common ownership. And then as a passive investor, you're perfectly happy to say, well, this sounds very good. I don't actually want to have such strong performance sensitive compensation because that would only lead to more competition, which I, as a diversified shareholder in this industry, do not actually want. Now, conversely, that should mean that activist shareholders, which tend to be actually undiversified, so they only own one firm in each industry, they should take a much more active role when it comes to executive compensation. That's also what we see. Okay? So when activist shareholders come in, they actually have a strong effect of changing compensation in a way that is actually much more performance sensitive. Okay? But the way that this comes about, at least the way we see it in our data, is when you have more common ownership, the compensation becomes performance insensitive precisely because those shareholders tend to be relatively passive. It's not privately optimal for the firms, right? So each firm by itself would be better off if it adopted a less, a more aggressive strategy. Okay? But collectively as an industry, this is better. So if you have more common ownership, okay, you're going to care more about profits of other firms. Okay? So you're going to internalize this in the decisions that you make as a company. Okay? So that means now industry profits should be higher in industries where there's more common ownership. Okay? But they shouldn't be as high in industries where you have less common ownership. Okay? But that's not to say that it wouldn't be privately optimal for a single firm, maybe owned by an undiversified shareholder, to compete more aggressively.